Good evening. Welcome to IFRS 9 again. So, our next topic is reclassification. What is reclassification? Classifying the financial asset from one category to another category. Okay. Classifying the financial asset from one category to another category. For example, a financial asset measured at fair value through P&L account can be reclassified into FVT OCI. Amortized cost can be converted into FVTPL. FVTPL into amortized cost. So the issues involved are, when can we reclassify? Is it very simple that anytime you wish to reclassify you can? The answer is no. So there are situations when you can reclassify and there are situations when you can't reclassify. For example, you have learned an equity instrument designated as FVT OCI by the management cannot be reclassified into FVTPL. Similarly, a debt instrument which is designated as FVTPL, then they are not subsequently reclassified. So normally the designated instrument cannot be reclassified. Okay. But sometime because of change in business model, there may be a need to reclassify a financial asset. So earlier the entity was trading in the debt instrument, held for trading, but now the motive has changed. Now they want to collect the contractual cash flow, okay, and hold it till maturity. So they might have to shift from FVTPL to amortized cost. Or earlier the business model was either to collect or sell also, but now they want to completely move to only collection of the cash flow. So what will be the reclassification of from FVT OCI to amortized cost? Okay. And then what journal entry will you pass? It's very simple. Debit the new classification, credit the old classification, and there may be some difference because earlier one instrument may be measured at amortized cost and now it has to be measured at fair value, or vice versa. In that case, some difference may arise. So where the difference will be transferred to, that we will see. It may be P&L account or it may be OCI. It may be P&L account or it may be OCI. So very carefully understand, because it is very confusing which account you will debit or credit. An entity is required to reclassify financial asset when it changes the business model. So when can you reclassify the financial asset? When there is a change in business model for managing the financial asset. Because business model test helps us to decide what is the classification. Hold till maturity and collect cash flow is one model. Hold and sell, another model. Held for trading, another model. So when your business model changes, the classification will also change. Accordingly, a change in the entity's business model will occur only when an entity either begins or cease to perform an activity that is significant to its operations. For example, when the entity has acquired, disposed of, or terminated a business line. One example also I have given in your notes. Is it there? Example. Where is the example? ASF Limited has a portfolio of commercial loan. Is it there? That it holds to sell in short term. So what is my portfolio? Short term trading, held for trading, FVTPL. ASF Limited acquired a company that manages commercial loan and has a business model that holds the loan in order to collect the contractual cash flow. Now ASF Limited has acquired a company. Then what is the business model of this company, this company manages the loan by holding it till maturity and collecting all the cash flow. ASF Limited was holding it for short-term trading. Now what will be the portfolio after the business combination? The portfolio of commercial loan is no longer for sale, and the portfolio is now managed together. So my portfolio and this acquiring company's portfolio will be managed together with the acquired commercial loan, and all are held to collect the contractual cash flow. So now we have decided that all the commercial loan will be held for collecting the contractual cash flow. Will it give rise to the need to reclassify? Yes. What will be the reclassification of this commercial loan that was held for short term? FVTPL to amortized cost, because you are going to collect all the contractual cash flow. So the question in the exam after the case study would be, can ASF Limited reclassify its commercial loan? If yes, what would be the new classification? So the answer is yes, because business model has changed and it will reclassify it into amortized cost. When will you not reclassify? The standard says you will not reclassify when there is no change in the business model for managing the financial asset. If there is no change in the business model for managing the financial asset, do not reclassify. Certain things you already know: investment in equity instrument that were designated as at FVTOCI at initial recognition cannot be reclassified, since the election is to designate as at FVTOCI is irrevocable. Is it right? So equity instrument designated as FVTOCI cannot be reclassified, and similarly the instrument which are designated as FVTPL are also not reclassified. It is not appropriate for financial asset that are designated as at FVTPL. Can a financial asset be designated as FVTPL? Yes, to ensure accounting consistency, to avoid accounting mismatch. Do you remember accounting mismatch? So in order to avoid accounting mismatch, even though a debt instrument may fulfill the definition of either amortized cost or FVTOCI, the management classifies at FVTPL. Such instruments are also not reclassified. So can I say designated instruments are not reclassified? Instruments which are designated, you have made a choice. So think before you made a choice, like CA course. You can't later change your decision. Is it right? Now I hope the concept is clear. What is the meaning of designation? You understood? You have made a choice. Reclassification and derecognition are not the same thing. Reclassification and derecognition. Reclassification is changing the classification of the instrument, whereas derecognition is, as you know, removing the asset from the books. Now, if a convertible bond gets converted into equity share, what will you do? Will you call it as a reclassification or a derecognition of debt and recognition of equity? A convertible bond converts into equity share. So you will say that the debt is derecognized and equity will be recognized. Okay. Because then you are shifting from a debt instrument to an equity instrument now. So if the terms of an instrument change sufficiently, equity and debt are sufficient change to warrant derecognition, then it will not be called as a reclassification. Instead, the old asset will be derecognized and the new asset will be recognized. Example also I have written. Entity X invest in a convertible bond of entity Y. Upon conversion, entity X will receive a certain number of entity-wise non-derivative equity instrument in exchange for giving up its right to receive the principal on the bond. On conversion, the convertible bond is derecognized and ceases to be measured at FVTPL. Okay. So what we will do, we'll first derecognize the convertible bond, because this is a huge change from what was the nature of the instrument earlier. It was a debt instrument and now it is an equity instrument, and the equity instrument may be recognized. Now while recognizing equity instrument, again you have to see, can we classify it as FVTPL? When will you classify it as FVTPL? If it is held for trading. If not, then check, does the management wants to designate it as FVT OCI? Then you can designate it as FVT OCI. Okay, so this question in the exam would be after this case study. Is it a reclassification or is it a derecognition? So then your answer would be, it is a derecognition. The conversion does not give rise to reclassification because the original instrument is derecognized. Now we'll see the accounting of derecognition. This one thing is simple: debit what comes in, credit what goes out. Is it right? So if amortized cost is converted into FVTPL, so debit FVTPL, credit amortized cost. But then the question is, what is the amount and what is the treatment of difference? At what amount you will classify into new instrument, and what will be the treatment of the difference between the book value of the old instrument and the book value of the new instrument that you have debited, right? So first golden rule is, all reclassification will be given prospective effect from the date of reclassification. Don't go into the past. Whatever interest you have recognized, dividend you have recognized, gain or loss you have recognized, impairment loss you have recognized, they will not be restated. Okay. So no adjustment for any figure recognized in the past in profit and loss account. Till the date of reclassification, you do the accounting as per old method of classification. Suppose on 7th July you want to reclassify. Then up to 7th July, first you follow the old method. Whatever is the nature of that instrument, there are three categories only: FVTPL, FVTOCA, amortized cost. Whatever we have learned till yesterday, you do the accounting up to the date of reclassification. For example, also we have written, if it is an amortized cost instrument, then you calculate the effective interest up to the date of reclassification. Opening balance into effective rate into time, principal rate time. Principal will be opening balance, rate will be effective rate, and time up to the date of reclassification. And suppose it is a FVTPL or FVTOCI instrument, then you calculate the fair value on the date of reclassification. So up to the date of reclassification, first you see what would be the carrying amount of the old instrument. Is it right? And then you shift the book value of old classification to new classification. And after reclassification, see what is the new category. Financial asset will be measured at fair value if the new classification is FVTPL or FVTOCI. The fair value will be determined on the reclassification date. And if the new classification is amortized cost, henceforth you will follow amortized cost accounting. We will discuss one by one now. How many combo is possible? 6. Which 6? Listen to me. Amortized cost to FVTPL, FVTOCI, 2 combo. FVTPL to amortized cost, FVTOCI, 4 combos. Then FVTOCI to FVTPL, amortized cost. So 6 situations we are going to deal now. Small example on each situation. First is Case 1. Case 1, amortized cost instrument is reclassified to FVTPL instrument. So now we are moving from amortized cost. Means earlier this instrument was carried at cost. So up to the date you calculate what will be the carrying amount, opening balance plus effective interest up to the date of reclassification, and then you are moving it to which category? FVTPL. And how is this instrument measured? At fair value. So the fair value will be measured at reclassification date, and that is the amount at which you will debit the instrument and credit the book value of the amortized cost instrument. Any gain or loss arising from a difference between previous amortized cost and the fair value is recognized in profit or loss. Question number. What is this question number for you? Solve. Bonds carried at amortized cost for rupees 1,25,000 reclassified as FVTPL. Fair value on reclassification is rupees 90,000. Fair value on reclassification is rupees 90,000. Journalize. Only one entry will pass. And remember my rule. Go debit what comes in, credit what goes out. So what will come in? FVTPL instrument. What is the fair value? So the same bond you will debit at 90,000. And what is its carrying amount? 1,25,000. What is the gain? 35,000. Gain? Then why you said yes? Loss. I was checking whether you are awake or not. Half of you are found to be sleeping. Bonds account debit 90,000, in bracket write FVTPL. Then the difference, P&L account debit 35,000 loss to bonds amortized cost 1,25,000. So this loss will be transferred to profit and loss account. Okay. You have written the entry in the notebook properly. Now case 2 is amortized cost to FVTOCI. Same situation, but now the instrument will be reclassified as FVTOCI. This new instrument will also be measured at fair value. Old instrument will be derecognized, and this time the difference will be transferred to OCI. Bonds carried at amortized cost for rupees 1,25,000 reclassified as FVT OCI. Past journal entry. Bonds account debit 90,000 FVT OCI. Then OCI account debit 35,000. To bonds amortized cost 1,25,000. So easy. If it was reclassified as FVTPL, gain or loss transfer to PL. If it is reclassified as FVT OCI, then gain or loss you transfer to OCI. Check case 3. FVTPL to amortized cost. So what is the earlier classification? Earlier FVTPL. And what will be the new classification? Amortized cost. So the question is, at what amount you are going to show it as amortized cost? Are you again going to recalculate from the beginning and see, had I followed amortized cost, this is what the value would have been, or simply forget the past? Today what is the value? Take that as a starting point, as the amortized cost of the new instrument. What will you do? So the instrument standard says the fair value at the date of reclassification becomes its gross carrying amount. Don't do retrospective calculation. First line only it was written. All adjustments will be done prospectively. So this new fair value today becomes the carrying amount under amortized cost, and henceforth you will calculate the effective interest rate and do the accounting. So then you have to recalculate the effective interest rate. We have learned yesterday while solving that last question that since your base value will change, you will see this is my fair value, these are my future cash flows, compute the effective interest rate again, compute the IRR again, and then do the accounting as per amortized cost. Question number 3 next. What is the third example on this issue? Bond of rupees 1,25,000 at FVTPL is reclassified to amortized cost. Fair value on the reclassification date was 90,000. Now from 1,25,000 book value, first I have to write it off by 35,000 because it's a FVTPL instrument. So I have to reduce its value first. Is it right? So the new instrument, bond amortized cost debit, 90,000, and this loss is impairment loss, because what the standard says, first you will have to bring the value as on the date of reclassification. So my book value in the morning was 1,25,000. Then in the afternoon, management thought no, we should reclassify, and now the value is 90,000. So the value of that instrument has declined by 35,000. So this is the impairment loss, 1,25,000. Anyway, it will be charged to P&L account. You can just write in the exam P&L account debit. FVTPL to FVTOCI. So the financial asset continues to be measured at fair value. Okay. But what if there is a difference? What is the old classification of this instrument? FVTPL. So first you have to do the fair valuation on the date of reclassification. So when you do the fair valuation of that FVTPL instrument, there will be a loss or a gain. So first you transfer that gain or loss to P&L account, bring it down to 90,000 rupees, and then you reclassify it as FVTOCI. Because it's an FVTPL instrument right now, before. So the standard says first you follow the accounting up to the date of reclassification using old criteria. So if an instrument whose book value is 1,25,000 classified as FVTPL goes down to 90,000, what I'll do first? I'll first reduce its value, and it is an FVTPL instrument. So the loss will go to first profit and loss account. Then its book value becomes 90,000, and this 90,000 I shift to FVTOCI. So entry will be bonds FVTOCI account debit 90,000, impairment loss taken to P&L account 35,000, to bonds FVTPL 1,25,000. How many cases you have covered? Anybody who is keeping a tab? 4. Very good. FVTOCI to amortized cost. FVTOCI to amortized cost. So FVTOCI instrument will be first valued up to the date of reclassification at fair value, and that fair value becomes the amortized cost of the amortized cost debt instrument. Is it right? So don't do retrospective calculation. Today's fair value becomes the new gross carrying amount of the amortized cost category. Okay. Now there is a question, bond FVTOCI 1,25,000 reclassified as amortized cost. Fair value on the reclassification is 90,000. So you will debit the instrument, amortized cost instrument, bond amortized cost at fair value, and its book value was 1,25,000. This 35,000 loss will be adjusted in OCI. because it was classified as OCI earlier. So the moment you do the fair valuation of this instrument, the difference first goes to OCI. Now it is ready to move to amortized cost. Then you jump it to amortized cost. Okay. So you can just write OCI, reserve account debit. Some name you have to write in the statement of profit and loss. So you will write loss allowance. And the last, sixth possibility, FVT OCI to FVT BL. Earlier also it was at fair value. Now also it is at fair value. So we are moving from fair value to fair value. Okay. So write down bond FVTPL account debit 90,000. And this time again the old instrument is OCI. So as we discussed, up to the date of reclassification you apply old accounting. So when you do the old accounting, first you will have to pass an entry OCI reserve account debit to FVT OCI. Is it right? Because it's OCI instrument right now. So up to the date of reclassification, first you bring it to fair value, which means you have to write off 35,000 in OCI first. To bond account 1,25,000. So this will be adjusted in OCI. So these are the 6 simple questions. Rest is your luck. Come to next. One more long discussion on regular way purchase or sale of financial asset. Accounting of financial asset already discussed since last 2 days, but you will learn a concept called trade date accounting and settlement date accounting. Is it right? First we will understand the meaning of regular way purchase. Regular way purchase. Regular way purchase means you simply pay the price, you receive the goods. Is it right? That is regular way, normal way, as per the convention, as per the terms and condition of that particular business. For example, I want to eat sweet. I go to a sweet shop. Okay, sweet shop, and I say I want to purchase half kg laddu. He says, you first enter into a contract with us. Sign this 100 rupees stamp paper and we will deliver you after 3 months. Does it happen like this? It doesn't happen like this. By the time he will tell me sign this contract, I will run away. I will say, you give me the product, laddu, and I'll give you the price. But suppose I have to buy share from the stock exchange. Does it happen like this? Oh, I am paying you money, give me the share. Doesn't happen. In share market, what will happen? You will place an order. The system of BSC and SC will match your order with a opposite customer who wants an opposite position. You want to buy, there must be somebody to sell. It matches the two order. And do you get the delivery immediately in your demat account? Then T plus 2, transaction date plus 2 days. After 2 days, you will find those share you purchased are reflected in your demat account. That is the convention of that market. Is it right? So different assets are sold in the market, but have different convention as far as giving the delivery and making the payment is concerned. So laddu you can buy across the counter, pay the price, get the delivery. Share you take about 2 days to deliver and receive the payment. Okay. Such transactions are called regular way purchase, normal. But if I say, I will pay you after 3 months 600 rupees, you deliver me 1 kg of laddu, is it a regular way of purchase? No. That becomes a forward contract, a derivative contract. Is it right? Derivative will be discussed separately in this chapter. And that is also today's topic only, after some more discussion on financial asset. So that will be treated as derivative. So normal way of purchase is called where you take the delivery and make the payment within the stipulated time framework established by the regulations and conventions. So different market may have different convention. I gave you two examples. Some market may deliver after 4 days also. Okay. But there are contracts which require you to permit net settlement of the change in the value of the contract. That means after 3 months, if the price goes up, I will get the difference. If the price falls, you pay me the difference. There is no need to deliver laddu or make the payment. After 3 months, I go there, price of laddu is 650 now. I said, I don't need laddu, you give me 50 rupees, I am the winner. Is it a regular way purchase? Don't try that option. The shopkeeper will throw you out. I tried that once. Now, instead, you have to see how do they react. Na? See, they told me, let me call my head office and find out whether we can do this for you. The head office also said, let me call the owner and see if it can be done. I said, let it be. It was just a test. Instead, such a contract is accounted for as a derivative in the period between the trade date and the settlement date. But you should try something new, okay? And don't be afraid what he will say. Let him say, at least you got some entertainment. Now, there are two ways you can do accounting of a regular way, sale and purchase of financial asset. The standard permits you two methods. These are called trade date accounting and settlement date accounting. I have seen most of the companies follow trade date accounting only. Easy, simple. But yes, you can follow settlement date accounting. You have to choose your accounting policy and then follow the same policy for all the financial asset for that year. Is it right? So what is trade date accounting? It is the accounting system where you bring the asset in the books on the date the entity commits itself to purchase or sell an asset. Let us take the example of share market. You place an order on 1st February, but your demat account is credited say on 4th of February. Okay, because there is Saturday, Sunday also. So maybe they take 2-3 days to credit the share into your account. When you place an order and your order is executed, you get a message on your mobile phone, SMS, that your order for this many shares at this rate has been executed. Then you receive a mail also on the same day in your email account that you have purchased so many shares. But your demat account is not credited or debited on the same day, but at least you get the message that your contract is executed. So this is the date I have committed to purchase or sell the shares. So I will pass the entry. Suppose I buy investment account debit to amount payable. If my account has not been debited, I will write to amount payable to the seller. So this is called trade date accounting. Even though I have not yet received the financial asset in my demat account, but I have committed myself to purchase that financial asset. We have entered into a contract. Okay. Settlement date is the date when the asset is delivered. So if I follow settlement date accounting, then on 1st February, there is no need to pass the entry. And directly on 4th February, I will pass the entry investment account debit to bank account, because I will have to pay the amount also on the same day. Assuming this is not important, you pay on 1st or you pay on 4th. So accordingly you can write. If you pay on 1st, then accordingly you will write. But normally for classroom and exam purpose, we will pay on the settlement date only. The issue is when the financial asset will be recognized. So in trade date accounting, financial asset is recognized or de-recognized. Recognized as well as de-recognized on trade date. And in settlement date accounting, the financial asset is recognized and derecognized on settlement date. So it will make some impact on your financial statement. Because if you are following settlement date accounting, the problem normally arises when you are close to the end of the year. Okay. Trade date is 29th March and settlement date is 2nd April, 1st April. 100% exam questions are like this only. Purposefully, they want to extract money from the innocent people. Now, yes, first exam fees, then revaluation fees. Okay, then again exam fees. So, wait. Trade date accounting, financial asset purchased or sold should be accounted for on the trade date. So, on that day only we will bring the asset or liability in the books. And in case of settlement date accounting, we will record it on the settlement date. So, if you are close to year ending date, then if you follow this method, the asset will be reflected in your financial statement. But if you follow this method, the asset will not be reflected in your financial statement. Of course, disclosure requirements are there where you'll have to give the disclosures. But the disclosure standard is separate, coming soon. What about if you're following settlement date accounting, there is a problem. What about the change in fair value between the trade date and settlement date? If you're following settlement date accounting, what about the change in fair value between trade date and settlement date? Because on trade date, you have become a party to the contract. Is it right? You have entered into a contractual rights and obligation situation. So there is a contract and you are a party to that contract. So if the fair value changes, other than amortized cost category instrument, because amortized cost you have learned, the change in fair value is not recognized. Other than amortized cost category instrument, if there is a change in fair value, you have to recognize that also. Even though asset is not recognized, but because you are a party to a contract, the fair value of that contract has either gone up or come down. So you have to recognize that fair value change. Is it right? And the treatment depends on the nature. FVTOCI recognize in equity account, OCI. And if it is FVTPL instrument, change in fair value recognized in P&L account. If it is amortized cost instrument, not recognized. Change in fair value is not recognized. Is it right? So now what you do, since you are in half sleep mode, write down the scheme of journal entries. If you are following trade date accounting, these entries are passed for buyer. That is when you are buying the financial asset. For sale, reverse the entry. In case of sale transaction, what you will have to do? Reverse the entry. Is it right? Reverse the entry intelligently. So if I have written no entry, don't reverse, yes entry. Okay. Intelligently reverse. Payable will become receivable if in case if you are selling. Okay. So some basic care you will take while passing entry in case of sale. So today as a homework, you will practice what entries would the seller pass. What entry would the seller pass? Okay. And there are 4 situations, 4 times I have to pass the entry. First is trade date. That means the day we enter into the contract. Okay. The date we have entered into this contract. So you will pass the entry depending upon what is the classification. If it is amortized cost, right, investment account debit to payable account. Okay. Investment account debit to payable account. And if you want to write what will be the amount, then it will be fair value plus transaction cost. Fair value plus transaction cost means brokerage, stamp duty, commission, that also you add. Now this amortized cost is possible only for debt instrument, is not possible for, fill in the blanks, is not possible for equity. So this column is only applicable for debt instrument, only debt instrument, whereas these other two are applicable for equity plus debt instrument. E for equity, D for debt. Our alphabet is different. A for accounts. Okay, now second, FVT OCI. Investment account debit to payable account, same, fair value plus transaction cost. And then FVTPL will be different entry. Investment account debit, fair value, transaction cost account debit separately, because that will be transferred to P&L account if it is an FVTPL instrument. In FVTPL instrument, transaction cost is later transferred to profit and loss account. It is not included in the carrying amount of investment because my objective is to trade in that instrument. Is it right? Not to hold it for a long term. To payable account. To payable account. Payable account, just ignore this line. To payable account. To payable account return. Come to next line. This entry you will pass on trade date. For understanding purpose, we'll assume trade date is 29th March. And then suppose between trade date and settlement date, suppose you have an year ending date. Suppose you have an year ending date. Otherwise, this will not be required. Suppose trade date is 29th March and settlement date is 1st April. Your books are closed on 31st March. So then what will be the treatment on year ending date, reporting date? This situation will come only if the year ending date comes between trade date and settlement date. As I said, mostly your exam question will be like this only. Trade date in one financial year and settlement date in another financial year. So write down little fast. On in case of amortized cost, no entry. Why? Instrument is not measured at fair value. In case of FVT OCI instrument, we are assuming there is a gain. We are assuming there is a gain. Think positive. Okay. Investment account debit to OCI. However, reverse the entry in case of loss. That you can do. And FVTPL investment account to P&L account. Gain. For loss, reverse it. That means if the fair value has gone down, you reduce it. Then settlement date. I will make the payment to the seller. Payable to bank. Settlement date. Payable to bank. Payable to bank. Payment of amount due. Written. And then one more thing you will do on settlement date. You will recognize the change in fair value. No entry again because it is an amortized cost. Investment account debit to OCI. Investment account debit to OCI. Investment account debit to OCI if it is an OCI instrument, and investment account debit to P&L account. This will be for gain, assuming that the fair value has gone up. Now this change in fair value will be between which two date? Between 31st March and 1st April. This gain will be difference between the fair value on 1st April and fair value on 31st March. So every time you have passed the entry for fair value, next time compare with the previously fair valued amount. Okay. This is for trade date accounting, which is usually easy. For example, suppose the question is silent about trade date or settlement date accounting. You see which one you are more comfortable with and solve. Write an assumption. Now let us write down the heading scheme of journal entry for settlement date accounting. 3 columns again. Trade date. So if you are following settlement date accounting, no entry on trade date, no entry on trade date, no entry on trade date. Okay, relax, no entry. But you have entered into a contract. You are a party to a contract. Now, reporting date. For again clarity, we will assume some dates. Suppose this trade date is 29th March. This year ending date is 31st March. And the fair value of that financial asset have changed. But if it is amortized cost instrument, no entry. If it is amortized cost instrument, no entry. If it is FVTOCI instrument, now there is one entry I have to pass. Fair value change account debit. I will not write investment account debit. Investment is not there in our book. So we'll open a temporary account. Okay, we'll open an account to record the fair value change, which can be a positive number also, which can be a negative number also, to OCI, because it is OCI instrument. And if it is an FVTPL instrument, then the change in fair value will be debited to one account called fair value change account. You can give it some other name also, to P&L account if it is FVTPL instrument. Many times student will ask, why you need to create an account here? I don't have an investment. You don't have an investment, but you have a contract. And the holder of the contract is going to enjoy the gain or loss if the fair value goes up or comes down. Substance over form. You have a contract to buy shares at a certain amount and its fair value have gone up or come down, and you want to show that instrument as FVTOCI or FVTPL, standard says you have to also bring that gain or loss in your books, so that the users of financial statement will know that you have entered into some contract to buy financial asset which is generating so much of profit or which is resulting into so much of loss. Is it right? Let the world also know what you have done. Yes, after the 2008 economic crisis in USA, they had entered into such contract, but it was never appearing in the financial statement anywhere. So they had to redesign the whole financial instrument standard. It took 6 years to now the current form of chapter that you are learning. 5 to 6 years, hundreds of meetings, hundreds of people involved in the project to redesign this standard on financial instruments, so that in future at least we get the signal something is wrong, okay, in advance, and then we can take necessary action in advance only. That is the reason. So certain things you are learning which you have never learned, it is new for you. Okay, no problem. Now come to settlement date. On settlement date we will bring the investment in the books, investment account debit to bank account, whatever we had agreed. No change in fair value will be recognized if it is amortized cost, and the amount you are going to debit will be fair value plus transaction cost. Agreed? If it is FVTOCI instrument, so you will bring the investment at fair value only. Bring the investment at fair value. That means I will put the date again, 29th March 31st March. Suppose this is 2nd April. So on 2nd April, whatever is the fair value, you pass an entry at that amount. So investment will be brought at fair value plus transaction cost. If there is a change in fair value between 31st March and 2nd April, I have written OCI on both sides. This time I have written on both sides because it can be loss also or it can be gain also. The fair value may fall or go up. If it falls, OCI debit. If it goes up again, OCI credit. Make the payment to bank. Make the payment to bank, and this fair value change account which you had opened here to record the change in fair value, now it is reversed. Now it is reversed. Close it. It's only for that period. Close it, and now you do the normal accounting from this date onwards. Is it right? So the student will have to keep in mind, we will record fair value change between the trade date and year ending date, and then that account will be reversed when you are going to recognize the financial asset. Okay. FVTPL same. Investment account debit, fair value on 2nd April. Transaction cost separately because it will be transferred to P&L account. How much care we have to see. Then if there is a decrease in fair value, P&L account debit. If there is an increase in fair value, P&L account credit. Make the payment to bank. Close the fair value change account. Right? If you want, you can break this into two parts also. Okay? Up to you. You can pass two entries like we did in the trade date accounting. Now we will solve one question number 35. Very, very important question. In one question, they will test accounting of both trade date method and settlement date and all the three instruments also. Only for the buyer they have asked. They might also add one more line in the question. Pass entries in the books of seller also. That you will try as? That you will try as homework. You have promised me. Let me see how many of you do it tomorrow. On 30th March 2014, 24. Fair value per ordinary debenture of A Limited was rupees 45. On this date, B Limited committed to buy 10,000 of these debenture at fair value. So this is called 30th March 2014 is called, or 24 is called. Tell me. This is trade date. This is trade date. Because you have committed to buy 10,000 debenture at fair value and the fair value is 45 rupees. So my original contract is that we will buy 10,000 debenture at 45. B Limited paid the price and accepted the delivery on 3rd April. What is 3rd April? Settlement date. B Limited closed the account on 31st March 2024. So this is reporting date. See the question. Reporting date has come between the trade date and settlement date. Fair value of A Limited debenture was 45.40 on 31st March 24, 45.30 on 3rd April 2024. Show journal entry in the books of B. Who is B? The buyer or the seller? Buyer? Yes. B Limited is the buyer of this debenture. If B Limited classifies the investment in A as amortized cost, financial asset at FVTOCI, financial asset at FVTPL. And we will solve it under both the system of accounting. Trade date accounting also, settlement date accounting also. You can solve in the book only because the format is drawn. Start. First we will solve amortized cost category. Okay, understand and then copy. First, case 1 is investment in A is categorized as amortized cost category. Under that, trade date accounting. Trade date accounting means you will bring the investment, the financial asset, on the trade date itself. That is the date you commit to buy or sell. 30th March 2024. You are following trade date accounting. Investment in shares of A Limited account debit 4,50,000 to payable account 4,50,000. You are going to record the asset and the liability on the trade date itself. Then there is a 31st March 2024. Array, why it is not written? It is amortized cost. So even if there is a change in fair value, ignore. Just like yesterday's homework you have ignored. Yesterday homework was given, na? Which homework? Ignored. 3rd April 2024. Just make the payment. Just make the payment. Again ignore the change in fair value. Payable account debit to bank. Payable account debit to bank. Done. Dear student, now tell me settlement date accounting for amortized cost category. Are we going to pass entry on 30th March 2024? Are we going to pass entry on 31st March 24? Are we going to pass entry on 3rd April? Yes, only one entry directly on settlement date. All change in fair value are ignored. Investment account debit to bank. Investment account debit to bank 4,50,000. Investment account debit to bank 4,50,000. This is very easy. Amortized cost category. And trade date accounting and settlement date accounting both are very easy. Now be careful because now we are moving to FVT OCI instrument. Okay. I have written a note. I don't know whether it is typed in your notes or not. In case of amortized cost category, no fair value change is recognized for financial asset at amortized cost. This note I have added. If you are interested, write it. No fair value change is recognized for financial asset measured at amortized cost. Okay. Because the student, they send me the email that, sir, why you have not accounted at fair value? This is amortized cost. Once I have committed at 45, 45, 45, 45. Okay. And then subsequently effective interest rate method we will follow. What is the next instrument I will take for discussion? FVT OCI. Under that, case 1, trade date accounting. Will you pass entry on 30th March 2024? Entry. Investment account debit to payable account. Fair value is 45 rupees. Yes or no? And 10,000 debenture you have bought. So 10,000 into 45. 4,50,000 to payable account 4,50,000. And then comes 31st March. On 31st March 2024, since it is a fair value at a financial asset at FVT OCI, I am going to do the fair valuation on this date. I am going to fair value this instrument on this date. Now look at your question. You purchased when it was 45 and on 31st March, what is the rate of this instrument? 45.40. Keep the question in front of you. Is it 45.40? So 45.40 means the value has gone up. So for the buyer it is again. For the buyer it is again 45.40 minus 45, 40 paise gain into 10,000. 4,000 and to fair value reserve account OCI 4,000 and to fair value reserve account OCI 4,000. Okay. So this closes my 31st March. Then I'll come to 3rd April. Either I can combine the two entries or I can pass separately also. So we'll pass separately because it's printed already. Payable account debit to bank. First to pay this payable. Will you pay him more than 4,50,000 or the same amount? Same amount. Why will you pay more? Whatever gain is your gain, not his gain. But today what has happened on this 3rd April, the rate has come down to 45.30. And we have earlier revalued it at 45.40. So 10 paise reduction. 10 paise reduction. Reverse this entry by 10 paise into 10,000. Fair value reserve in bracket OCI account debit. Fair value reserve OCI account debit. Write in bracket OCI 1,000 to investment account 1,000. Now here one question comes from the student side. What is the need to do the fair valuation on 3rd April suddenly? Actually this entry practically they will not do. This entry they will pass only on the reporting dates. Only on the reporting dates. Because this entry will remain internal only. It will not go to the stakeholders. But you are a student. So you will pass this entry up to the 3rd April change in fair value. Otherwise companies what they will do only when they have to report it. Suppose they have to report it quarterly. Then at the end of that quarter they will see what was the fair value earlier and what is the fair value now. It amounts to the same because it will ultimately go through the OCI. So every day if you pass the entry, it's a headache for you. But you are understand your position. Up to whatever date they will give you, you pass. Okay. Now we'll come to settlement date accounting. Be careful, settlement date accounting. What is the instrument heading? FVT OCI. In all settlement date accounting on trade date, no entry is passed. So 30th March, no entry. 31st March, entry will be passed. Because the fair value has changed. Fair value has changed. You have to pass the entry. You are a party to the contract. Fair value change account debit 4,000 to fair value reserve account OCI 4,000. Now how this 4,000 has come in calculation? 10,000, right? 10,000 into 0.40. Is it written? 10,000 into 40 paise appreciation in value of investment. And then come to 3rd April. 3rd April, what are the things we have to do? We have to bring the investment in the books at fair value on that date. At fair value on that date. So write 10,000 into 45.30. This has come. Now what is the decrease in fair value? 10,000 into 0.10. Last 31st March it was 45.40. Today on 3rd April it is 45.30. 10 paise decrease. So we have a loss. Fair value reserve account OCI debit 1,000. Calculation right, 10,000 into 0.10, 0.10. And then to bank account. How much I have committed to pay? 4,50,000. And this fair value change account, you reverse it here. To fair value change account 4,000. So now in your books investment will appear and fair value reserve account OCI will appear. Okay. Can you do the same thing for FVTPL? Only one change you have to do now. Find and replace. Find OCI. Replace by P&L account. Is it right? find and replace. So now entry on 30th March. FVTPL trade date accounting. Investment account debit to payable account 4,50,000. If you are following trade date accounting, bring the investment in your books on the trade date. And then since you have the investment in your books of account, you increase the value or decrease the value every time the fair value would change, and second effect in P&L account. So on 31st March, the fair value has increased by 4,000 to P&L account 4,000. Then we'll make the payment to the other party, payable account debit to bank. And on 3rd April, the fair value was reduced by 10 paise into 10,000. So 1,000 rupees loss. P&L account debit to investment account 1,000. Is it right? As a homework, you practice in the books of buyer and try in the books of seller. What is the last part of this accounting now? FVTPL settlement date accounting. 30th March entry. 31st March fair value change account debit to P&L account 4,000. Right? And 3rd April, bring the investment in the books at fair value. Recognize the loss if any between reporting date and settlement date. There is a loss of 1,000 rupees. P&L account debit 1,000. Credit the payment made to the counterparty to bank 4,50,000. Close the fair value change account to fair value change account 4,000. Is it understandable? After so many hours of hard work, now you have concluded financial asset for some time. Okay, we'll come back again. Now if you come to page number 20 of this chapter, page 20, starting point, 20, move behind. There is a summary of provision for financial asset. Do you want to revise or you will do it as homework? Revise. Okay, revise. So we will have financial asset of two types: debt instrument, equity instrument. Debt instrument has three classification: amortized cost, FVT, OCI, FVTPL. Subsequent measurement of amortized cost instrument is at amortized cost, FVT, OCI is at fair value, FVTPL is at fair value. Now what will you do for subsequent accounting in case of value changes? If it is amortized cost, interest, impairment loss, foreign exchange gain or loss will be recognized in P&L account, and on derecognition any gain or loss is recognized in P&L account. Only one note write down there: no change in fair value. Fair value change will not be recognized. Simple. Fair value change will not be recognized. That sentence I have not written. Fair value change will not be recognized under amortized cost category. Okay, last column. FVT, OCI, interest, impairment loss, foreign exchange gain or loss are recognized in P&L account. Other gain and losses are recognized in OCI. On derecognition, cumulative gain or loss in OCI is reclassified to P&L account for debt OCI instrument. And FVTPL is the easiest one. Change in fair value is recognized in profit and loss account every time. And next is, and there also you can say all interest, impairment, foreign exchange gain, loss, everything P&L account. You should just write there everything P&L account in the debt FVTPL. Then equity, FVT, OCI. Dividend is recognized in P&L account. Change in fair value is recognized in OCI. Now you underline, no reclassification of gain or loss to P&L account and directly transfer to equity. There is a difference between debt and equity instrument there. If it is debt instrument, OCI balance is reclassified to P&L account. Equity instrument, if it is classified as OCI, gain or loss is not reclassified to P&L account on derecognition. It is transferred to other equity account. Also, no impairment is recognized in P&L account. These are some tricks you have to keep in. These are some basic provisions you have to keep in mind. So if it is equity instrument OCI, other than dividend, your other items are routed through OCI. And then change in fair value, in case of fair value through P&L account instrument, is recognized in profit and loss account. So FVTPL means everything in profit and loss. FVTPL instrument. Now you can come back to this page. Financial liabilities. What is the definition of financial liability that we have discussed in IS 32? Is a contractual obligation to deliver cash or another financial asset, or to exchange one financial asset against another financial asset under conditions which are potentially unfavorable, or contract to deliver variable number of own equity share against a derivative or a non-derivative contracts. Okay, it seems you are listening it for the first time. Okay, so now come to the financial liabilities classification, meaning we have seen in IS 32. So in financial liability, the basic principle would be, you begin with the assumption that they will be classified and subsequently measured at amortized cost, because financial liabilities are usually your debentures, bonds, loans. This is what is your financial liability normally in your balance sheet. Is it right? But yes, there are other financial liabilities like trade payable, bills payable. So those can be measured at FVTPL. So generally most of the financial liabilities are measured at amortized cost, because our objective is to pay interest and then settle the principal on maturity. Is it right? But there are financial liabilities which can be measured at FVTPL. Example, right, derivative, which we are going to start after some time. If you have entered into a call option contract and you are a writer is exposed to unfavorable situation, risk situation. So normally for a writer of an option, the derivative would be a financial liability. Or if you have entered into a forward or a future contract, and if the market price has moved against your expectations, then that forward or future contract becomes a financial liability which can be measured at FVTPL. Is it right? Or sometimes we can designate also, that I will discuss later. Then financial liabilities that arise when a transfer of a financial asset does not qualify for derecognition, or when the continuing involvement approach applies. So this is a special situation which we discussed yesterday, that when you transfer the financial asset, you retain also significant risk and reward, you transfer also significant risk and reward, then we apply continuing involvement approach. So in that case, I had passed one entry in your book, if you remember. Financial asset at continuing involvement approach account debit to financial liability at continuing involvement approach. Is it right? So for that item, amortized cost method is not applicable. Those are measured at fair value. Then financial guarantee contracts. So guarantee contracts not designated as FVTPL, that are not accounted for under IFRS 17 insurance contract. Okay, commitment to provide a loan at a below market interest rate. These are all measured at fair value. and financial liabilities that are designated as hedged item and are subject to hedge accounting requirement. Now this is again a special rule which we have to cover, hedge accounting rules. So if suppose you have a derivative, so derivative if used for hedging purpose, then special accounting rules will apply. Or if there is a hedged item which you want to hedge, hedged item is something whose value you want to protect, and you are following hedge accounting rule, then you have to follow the special rule given in hedge accounting. But otherwise, amortized cost. Amortized cost, we have already solved many problems, including this problem, which is right now on your screen. But that day, we had solved the problem from the point of view of buyer, the investor. And now I'm going to solve the same problem from the point of view of issuer, the one who has issued this bond. Okay, how he will pass the entry. Already we have drawn that amortization schedule. Do you remember? No. On 1st January 2015, NTTA issued 10% debenture in the market for 53,993. The debenture has a principal amount of 50,000 that will be repaid on 31st December 2019. The quoted market interest rate is 8%. Prepare debenture account. Assume amortized cost category. Prepare debenture account in the books of A Limited, that is the issuing company. And the question has instructed you that you will follow amortized cost category. One good thing they have done, IRR calculation they have done. So what you do, dear student, first take out a notebook. In the books of A Limited, in bracket issuing company, in the books of investor, I had passed journal entry, if you remember, for 1 year, and I had asked you to complete for remaining 4 years, which none of you did. Now, don't worry. Write down first format, date, particulars, rupees. Date, particulars, rupees. What is the first entry this company will pass? Bank account debit to debenture account 53,993. Is it right? So write down the date here, 1st January 2015. By bank, directly write full amount 53,993. Then you will pass entry for interest at effective rate of interest. Entry interest account debit to debenture account first. Interest account debit to debenture account. Date write down 31st December 2015. By interest, you have to take 8% effective interest. 8% of 53,993. Effectively, you are incurring 8%. Effectively, your cost of raising the fund is 8%. This is your effective cost. How much is that? 4,3. And how much cash flow you are paying to the debenture holder? 10% of 50,000. 5,000. Third entry, 31st December 2015 to bank account, payment of coupon 5,000, 10% of 50,000. To balance carried down, this you have to tell me. And the balance carried down 53,312. Next year, 1st January 16, credit side Buy balance brought down 53312. 31st December. Buy interest 8% of 53312. 8% of 53312. 44. Okay, 4265. 31st December 16. To bank coupon payment 5000. To balance carried down 5257. Okay, 1117. Buy balance brought down 52577. Buy interest 8% off 52577. Date write down 31st December 17. Tell me. Then 31/12/17 to bank coupon payment 5000. Then to balance carried down. Come on. 51783. Okay, repeat. Credit side 1118. Buy balance brought down 51783. Then 31st December 18. Buy interest 8% off 51783. 4143. Then 31st December 18. To bank 5000. To balance carried down 50926. Next year 1119. Buy balance brought down 50926. Buy interest balancing figure. Wait. First come to debit side 31/12/19. To bank. How much I will pay? 5000 interest and 50,000 principal. Is it 55,000? So buy interest will be balancing figure 4074. This is amortized cost method. This is called amortized cost method. Now we will take a break.